I'm with Dominic, Head of Research at Binari Property, and we're talking about the Melbourne property market from an investor perspective. And the Melbourne market certainly missed the boat in terms of property price rises in the last 5 years. It's been, I think, less than 20%, whereas nationally it's 40-odd%, 46%, something like that.
Yep.
Is it time that Melbourne's going to be playing catch-up? Where do you see it heading for next year in 2026?
Yeah, I think we all suffer from a bit of sort of recency bias when we talk about property markets, and the last 5 years, Melbourne's been really poor. You know, I think the figures look like something along the lines of Melbourne's grown by about 8%, Brisbane 67, Perth 70 odd, Adelaide 70 odd, Sydney 30 odd. So it's very much missed the boat, as you say, in the last number of years. But that's not always been the case. You know, there was a long period there of about 20 to 25 years pre-2020 where Melbourne was actually Australia's best performing property market. So the last 5 years seem to be more of an anomaly than the norm. But there have been various things that have really impacted the Melbourne market, you know.
Well, I think it had globally, the longest city shut down the world, 262 days during COVID, which obviously had an impact with people exiting the Melbourne market.
Yeah.
Have they started to come back into the market?
Yeah, so during the pandemic, they obviously had the long lockdown periods, but they also suffered from having no one coming from overseas. Now, Melbourne and Victoria has always been the state or the city that has benefited almost the most from that overseas migration, which was always leading to Melbourne overtaking Sydney as a city from a population point of view. So that really hurt the market, having none of that. They then had the lockdowns, which made it a really unattractive and not a great place to be. So off the back of that, lost a lot of people to interstate migration. Right. Now, historically, they would have a positive net interstate migration figure, only slightly, but always positive, generally positive. During those years, they would lose 30,000, 25,000, 5,000 or 6,000 people per year. So it really, really hurt that market to go from being a city that grows a lot in population to sort of a city that is declining in population, I suppose, from a overseas and interstate perspective. That has changed though now, where it's the fastest growing state once again in an overall population perspective. They're no longer losing people to net interstate migration. So you would almost have to assume that with those two key and they're not locked down anymore. With those two key drivers there,
hopefully that stays the way.
Yeah, correct. With those three things, they're helping to improve the fortunes of Melbourne moving forward compared to what they saw previously.
Because you've had the price gap between Sydney and Melbourne. If you go back a few years, they were sort of level pegging, and I think in some areas it might have been slightly ahead of Sydney in terms of the average or median price. That's now back to quite a decent gap, back to like prices 20 odd years ago, 2026.
Significantly. Yeah, the last time it was this wide was 2003, I think, which was after Sydney had the Olympic boom, which kind of led to Sydney stretching away from most capital cities. So it's quite interesting to see the gap be as wide as what it is right now. And we travel to Melbourne quite frequently for work, and you kind of look at the property prices down there to be on the city fringe versus what people are paying in Sydney, and you can really see the value proposition of say Melbourne, and with incomes being quite similar and job opportunities also being quite strong, it's kind of hard to see why there is such a wide gap between the two. But things are all pointing at it really improving.
So in the Melbourne market, they've had also some government regulation where they've dropped the the land tax duty, which has caught a lot of investors who weren't previously paying for land tax, and I'm one of them that's now paying land tax every year. They've also had a few other legislative changes as well, and that's had an impact in terms of statistically, I think the number of residential bonds being placed down has quite significantly dropped off. I think 22,000 between 2023 and 2025.
Yep. The
flip side of that is it's allowed first home buyers to get into the market. I think statistically that over the same period is up. First home buyer loans, it was up about 74,000 additional first home buyer loans.
Yep.
That has flipped it, but the flip side of that is that in the Australian market you've got about 3.5 million investment properties. The government provides about 300,000, so more than 90% of the rental market is provided by private investors. Yep. So if the government curtails that, which they did in Victoria, and that's shown statistically that through, for example, rental bonds that have been placed down have dropped. So that's going to impact the availability of rental properties, which is then going to push up rentals, right?
Correct.
So the rental market's fairly strong at the moment, yeah?
Yeah, well, they got to a point where their vacancy rate reached 5%. And Melbourne has always been known for having a pretty low vacancy rate, always quite tightly held fundamentally because of the strong population growth they had.
Right.
That's now back down to 1.8%. So rental stock's kind of diminishing and rental prices are starting to rise. Now, what that's done is it's kind of pricked up the ears of investors who are kind of thinking maybe there's an opportunity there. And as a result, we've seen investor inquiry into Melbourne increase dramatically. We've seen auction clearance rates increase from 63% this time last year to 73% this time this year, or 75%. So there's been a jump up in a lot of the sort of key figures we'll look for.
I think days on the market.
Days on the market down, yeah.
well.
So there's been a lot of an improvement in a lot of those key data sets that will generally indicate the improvement in a market. The one thing that I think the lower land tax threshold has done is for a lot of investors who held properties for the last 5 years, who didn't see much growth, maybe had to reduce their rents during COVID, and then now are paying land tax every year whilst other investors have done really well on their properties.
Right.
They're probably kind of fed up with holding on to those and therefore then have sold them, meaning less investment properties. But what it's now done is, as you say, let more first home buyers in, which is great. But now they've got a bit of an issue from a rental point of view because not everyone is ready to be a first home buyer. A lot of people are still looking to rent.
So Victoria also has high stamp duties, although has there been some changes to at least buying off the plan for stamp duties? Because a few years ago, there was no, or effectively you paid stamp duty on the land price as it was allocated for your apartment. Then they brought in, similar to New South Wales, where you paid stamp duty on the purchase price. They've now changed that. Is that a bit of a backflip, or is it a backflip they're not acknowledging in the marketplace?
Kind of a backflip that's not being acknowledged. So I think with the introduction of the lower land tax threshold, they've hurt the investment market, which they are well aware of. Now realising that they need to bring on new supply to drive up availability of rental properties to soften this rental increase that they're going to see and the vacancy drop.
And you've got that national issue of supply, which is also a factor in.
Correct. Yeah. So they do need to increase new supply, and one way to incentivise new supply is to introduce some incentives. So they've introduced a stamp duty concession, which doesn't mean no stamp duty, but effectively, in simple terms, the earlier you buy off the plan, the bigger the stamp duty saving might be. So what that means is if you buy before construction has commenced, you get the largest stamp duty saving. And I think we've worked out on a $900,000 property purchase, you save about $30,000 from your total stamp duty of $50,000. So for a lot of people, where maybe saving up a deposit has proved to be quite the challenge, and then having to save up an additional amount for stamp duty, taking advantage of that reduction has been quite beneficial to get them into the market. Right. But that is, and the interesting thing is often these concessions are only available to first home buyers, but in this scenario, they're available to investors as well, which is an indication that the government wants investors buying the new properties.
Okay, correct. After getting them out of the market, they're trying to get them back in.
Correct.
Okay. So in terms of, once again, we're generalising because there's markets within markets, and indeed within a particular suburb, there's the housing market and the apartment market. Yep. So to generalise, where should people look at, or where should they stay clear, I suppose? Because in Melbourne, different to Sydney and the Gold Coast and Brisbane, you do have that potential for urban sprawl with house and land packages.
Yeah, Melbourne's very flat. If you've ever flown into Melbourne, you'll notice as you fly in that there's a lot of flat developable land for a fair distance, a lot more than what you'll see when you fly into places like Sydney, Brisbane or the Gold Coast. The one area that we would say to exercise a lot of caution would be those outskirt areas where they're labelled the urban growth corridors of Melbourne. There's a couple of challenges. One of them is that there is so much land available and no real scarcity factor and nothing to really slow down the amounts of supply that are brought on in those areas.
No. So once again, we're talking for investors here versus owner-occupiers.
Correct.
So owner-occupiers could
you
be
buy
fantastic.
Wherever you want to. Yeah. So I think from an investment point of view, buying in those areas naturally does increase your risk of lack of performance through the dilution of growth through the supply that gets brought on. So that's something you want to be wary of. It also can be quite competitive from a rental point of view because there's really no controlling of the ratio of owner-occupiers to investors in these areas. And when you speak to a lot of Melbourne locals, they'll tell you that the infrastructure isn't up to scratch for the amount of people that they're expecting to live in these outer skirt areas. So I think that there will be some challenges there. My preference for investors is to stick within a reasonable distance of the city, buy in the parts of Melbourne that are actually going to help you to leverage off what makes Melbourne attractive. Your ability to walk to great cafes, your ability to go to the great restaurants, jump on a tram and go watch the AFL at the MCG or the Australian Open or the F1. Be in the areas that actually are what made Melbourne the world's most livable city for 7 years running, and made it the cafe capital of the world, or and all those types of things. So you don't want to be on the outskirts where there is just an abundance of supply with no real limitations around how much can be brought on.
Right, okay. And then if you're in an apartment living there, possibly to areas that are adjacent to heritage areas, that you're going to have access to all that amenity, but also you're potentially not going to be built out.
Yeah.
And
I think you've just got to be super just be selective, like with anything. Melbourne does benefit from a lot of the city fringe suburb having some great heritage overlays and things like that, which protect, the view lines, but also can protect levels of supply coming on in certain areas. You can also find some apartment developments and apartments that have already been built that are very unique, very attractive, have attributes to them that make them quite attractive, whether it be a blend of heritage and sort of more modern designs and architecture and things like that. So there are definitely pockets where you would preference.
Yep.
So finding those points of difference and utilising those heritage overlays and things to pick the right areas can be crucial to buying the right kind of property.
Right, okay. So I get a sense after 5 or so years of a pretty ordinary property market from an investor perspective, the market's turning and has shown signs of turning for investors.
Yeah.
So for 2026, you see that the early flower, the early blooms that we've seen, that's going to continue into
I think
2026.
so. It's always hard when a market is sort of teetering on the edge of really sort of showing all the right signs. I remember when other markets did that, it sort of lasted for a couple of years before it really kicked off. But I do definitely think that you're closer to the bottom than you are to the top in Melbourne because of the struggles it's had, and everything is indicating improvement, from rising population growth to reducing vacancies to rising rents to increasing auction clearance rates to reducing days on market. If there's 10 things you look for in a market to sort of determine whether or not it's going to head in the right direction, it's showing most of them. So I definitely think that 26 and beyond looks pretty positive for Melbourne.
Right. Dominic, thanks for your insights into the Melbourne property market for 2026.
Thanks, Grant.